Hi guys, hope you're fine. Welcome back to my channel. And I've thought, actually I announced this before, that I'll be starting a series, and this is what I'll be naming it: Mastering ICT Trading from Basics to Advanced Strategies. And this is the first episode, which will focus on what ICT trading is. But before we start, here's a disclaimer, because I have to let you know that I'm not a financial advisor and I'm not trying to help you with investment advice or any type of trading advice or financial advice. So this is for my safety and your safety. Please do go through the disclaimer to actually understand that this is for educational and informational purposes only. And we will start here and ask the question, what is ICT trading? And this is the first video of this series, hence it is labeled 001, and this is an ultimate guide for beginners. Now, here is the definition of what ICT is, or ICT trading is all about. It is a methodology that aligns retail traders, or helps us as retail traders to align ourselves with institutional strategies of trading. And by institutional strategies, we simply mean how the large or big institutions trade, like large banks and so on. It also focuses on understanding the market behavior through key concepts like your market structure, order blocks, liquidity or liquidity pools, and fair value gaps. Let's jump right into market structure. And what market structure is simply, or what it does, it helps us identify trends and reversals. You can see right here I have a chart of my own where I've marked out some fair value gaps and some highs and lows. Well, just highs it seems. Yeah, but this is simply what market structure does. And by market structure, we're simply talking about how the market is displayed, or is displaying or showing. What is it showing to us? That is market structure, and it involves highs and lows, your fair value gaps, your order blocks. These are involved in what market structure is. But mainly, it helps us with the direction. We get to discern the direction of the market using market structure. We are going to go deep into this in the next videos. And let's now talk about order blocks. And order blocks are simply zones where institutions place large orders, often causing significant price reaction. Now you see, when price goes back to an order block, most of the time we know that institutions are placing orders here, and therefore that order block will hold and maybe push price lower or push price higher. And what an order block in this case is simply, in this case on the chart here, as these 1, 2 upward moving candles. These upward candles are going to act as an order block when price returns and closes below this order block here, and then revisit this order block. Price will tend to be pushed lower. And you may realize that another candle may form here and creating a fair value gap, a bearish fair value gap here, and price may tap into both the order block and the fair value gap and then shoot lower. And what we call that is that it is multiple confluences. It simply means we have many confirmations that we are really trying to push lower. But let's move on to the next item, which is liquidity or liquidity pools. Now, liquidity areas or liquidity pools are highs and lows, and they are usually targeted by institutions to trigger stops or to execute trades. That's where they'll place their trades, or that's where they're trying to, trigger your stops. I know most people will have a problem with this, but in ICT, this is what we are taught, and this is what we believe, that they are trying to get to certain levels because they know that we anchor our stop losses on highs and lows, and so they will drive or push price there to then trigger our stops and take us out of the trade, and then continue to go in the direction that was predetermined. But that is a story for another day. And here I have a swing low. A swing low is simply where you find that you have these two down moving candles and this upward moving candle that actually went and took the low of that previous bearish candle, creating this swing point or this low here, and then move higher, right? And the way we actually identify a swing point, in this case a swing low, we simply want to see three candles: candle number 1, candle number 2, and then candle number 3. And what we expect to see here is that candle number 2 has a low that is lower than that of candle number 1, and it also has a low that is lower than that of candle 3. That is a swing point or a swing low. We'll get deeper into these. This is simply an introduction, a video of the series. Now let's carry on to fair value gaps. Fair value gaps are price imbalances that often get filled later, which means a gap will be left like this as price is in a hurry to reach maybe a draw on liquidity or a high somewhere up above here, or a fair value gap that is above where price is trading right now, and so price rushes to reach that point, and as it does that, it tends to create these imbalances and inefficiencies, and these form, or this kind of price action forms a gap in price. As you can see, this candle was pushing higher, and then this candle was also pushing higher, and then this candle couldn't even fill this gap, and price continued to shoot higher. So this is a fair value gap. But what we normally say again is that a fair value gap is a 3 candle pattern: candle number 1, 2, and 3. Candle number 1 can do whatever it likes. It can go as high or be as low as it wants. And then candle number 2 has to be an expansion candle. So price has to push aggressively high or low, depending on whether we are forming a bearish or a bullish fair value gap. In this case, it is a bullish fair value gap, so price pushed higher. And then candle number 3 has to have a low that does not touch the high of candle number 1, hence creating this point or this space here. And now that is a fair value gap. And by the way, fair value gaps are like the boss of ICT trading. If you don't understand fair value gaps, you are going to really struggle trading ICT. So the first thing I would suggest you do is make sure you understand fair value gaps. There are many other PD arrays that you have to learn about, but fair value gaps are the boss of every other PD array. And by PD array, what I mean is premium and discount arrays. And now, in terms of discount and premium, let me not just bombard you as of now, but just know that these concepts that I've just talked about are called PD arrays. Now, let's look into the importance of higher time frame analysis, HTF analysis. That's how I will abbreviate it. Higher time frame analysis is crucial. I mean, it's very important. If you don't do higher time frame analysis, you probably aren't going to succeed in trading, especially ICT trading. I've had other people who use different methodologies talk about higher time frame analysis as well. But now, for us, it provides a clear view of the market direction, and it helps us traders to avoid a lot of confusion and simply align ourselves with institutional traders, which simply means we tend to use higher time frame analysis to discern or to find out where we should be placing our trades and where we should be taking our profits and where should our stop losses be anchored. And so it is the basis of trading, this higher time frame analysis. Now, when you couple this with fair value gaps, you become very, very powerful in trading. And now we are talking about higher time frame analysis, and these here are the higher time frames. And we have at the highest monthly time frame, and then we have the weekly time frame, which is directly below the monthly, and we then have the daily time frame, which simply comes below the weekly, and then we have the 4 hourly as our last higher time frame. Yeah. So, and since as we see these higher time frames, they vary in the level of importance. The highest importance is the monthly, followed by the weekly, followed by the daily, and followed by the 4 hourly time frame. Now, this simply means if I identify, let's say I identify a trade idea on the monthly, I don't have to go down to the weekly, daily, and the 4 hourly. But now that's going to depend on the type of trader that I am, or the way I trade. If I want to be trading in a way that I'm a swing trader, then that's fine. But if I'm a scalper or I'm a day trader, I may struggle with finding trades based only on the monthly time frame. But the monthly time frame is very important. If something, or let's say for example, if the direction on the monthly time frame is bullish and it is weekly on the it is bearish on the weekly, you're going to have a hard time using the weekly to have winning trades. You are going to have to make sure that your weekly is aligned to the monthly for you to then use the weekly successfully, which simply means the bias or the direction should be the same for both. And so the monthly essentially dictates what the weekly should be doing. So you have to be aware of the monthly, and that's why when we do our analysis, we start with the monthly every single day, every single instrument. You start with the monthly, look at the weekly, look at the daily. Depending on where you find your setup, you keep going until the 4 hourly. But that's how important higher time frame analysis is. It is essential, it is crucial. And that brings us to the end of the video, and thank you for watching. And I want you to simply like if this video has maybe shown you some things that you didn't know, or taught you something, or it was quite interesting to you. Please click the like button. Also subscribe. Tell somebody who wants to learn about trading to come and subscribe here, because I'm sharing here my journey basically, and with these type of presentations I'm hoping to also teach at the same time. And so yeah, you're welcome to like, subscribe, share, and comment. Ask questions. Let's engage. Let's talk about trading. Let's talk about ICT trading. With that said, thank you for watching this video. I hope to see you in another one. Bye.